everyone, welcome to The Money Show, your one-stop destination for all personal finance queries. I am Snehi Shah. We have lined up a power-packed show for you today, and on the show we'll be chatting with Mr. A.R. Hemant of Bank Bazaar on their latest report. But on that note, viewers, also remember to keep sending us your queries on our WhatsApp number 865-797-4571. Or remember, you can also email us your queries on themoneyshow@etnow.tv. But on that note, let's kickstart this very interesting discussion with Mr. A.R. Hemant, the head of communications of Bank Bazaar, on their recently published report, Money Mood 2025. Now, Bank Bazaar has just released an insightful report on how India invested in 2024, shedding light on the latest trends in savings and investment patterns, preferred asset classes, and even emerging shifts in the insurance sector. As we step into a new year, understanding these evolving financial behaviors is crucial, especially with India's rapidly growing economy and changing consumer preferences. Now, from equities to government securities, from traditional saving instruments to the expanding role of insurance, this report provides a comprehensive analysis of the strategic decisions shaping India's investment landscape in the coming year. Without further ado, Mr. Hemant, welcome to the show. Throw some light on how India saved in 2024, and surprisingly, despite the run-up that we've seen in SIP flows in demat accounts, savings banks account still continues to be a preferred saving option. Why is that so? Could you explain that to us?
Thank you, Snehi. So, see, the number one trend that we are seeing, and this is over many years, is that people now prefer mutual funds and mutual fund SIPs. That's clearly the best way that everybody has decided for themselves to save money for long-term goals or short-term goals. And this has also led to a divergence between SIPs and mutual funds and the traditional options that existed before, right? So the traditional options would be obviously fixed deposits, government schemes, life insurance policies where you can also invest. So those things are having a declining market share in our survey, which we conduct once a year. And there's an increasing share for mutual fund SIPs. The interesting trend that happened in 24 and 23 also is that, look, the interest rates have been very high. So FDs have been very attractively priced for investors, right? So we get 7.5% on some of these short-term FDs now. What is interesting is that this year, the share for FDs in the overall pie went up, but there's a growing divergence between SIPs and FDs. So the gap between FDs and SIPs was about 1% in the earlier years, and it has gradually grown to about 5%. So more and more people are moving away from these traditional instruments of savings and going into SIPs, where they clearly believe that they can get inflation-beating returns. They'll be able to achieve their financial goals. And there's so much transparency there in terms of pricing, in terms of returns, when you can pull your money out, how much you can invest, when you can stop the investment. All of those things offer you so much flexibility. So that is what people are now clearly preferring. And just one more insight that I would like to add in that is that there is also clear preference for index funds. So some of the biggest mutual funds that we have today are index funds, Nifty 50 fund, Sensex fund. People have realized that this is the best way, the most low cost way also to save for, a 10-year period or 20-year period for the retirement needs or for the children's education, for all sorts of other long-term goals that may have, Snehi.
Okay, perfect. But just on that note, continuing that point ahead, Mr. Hemant, investors are preferring the SIP mutual fund route, like you correctly mentioned. But this is being preferred over directly investing in the stock market. Now, in fact, when I take a look at your report, the direct route is being trumped by options like saving in FDs and provident funds and postal schemes over directly investing in equities. Can you help us understand this popularity that on one hand mutual funds and SIPs are seeing, while on the other hand direct investment into equities is so low on that pecking order?
It's very interesting, right? I mean, this surprised us as well, because we see so much enthusiasm about participation in the retail markets. But I think several factors would have contributed to that. One is that clearly, there is this F&O phenomenon that played out through 24, and a lot of regulatory tightening also happened on that front. People lost money. People had suffered some, dire results as a result of what they chose to do on the stock markets. That's number one. People realize that's not for them, and maybe they need to have some kind of stabler, more sustainable way of investing. Number two, mutual funds had a great year. That also contributes to this whole trend, right? Where people realize that if you just do an SIP for 5,000, 10,000 rupees every month, the wealth accumulates over time, gradually, sustainably, and it takes away all the difficult decision making that comes with direct equities, right? Where you don't have to decide what to buy, what to hold, what to sell. Those are extremely difficult decisions, even for professional fund managers. So, how would the average retail investor be able to beat the indices regularly, right? So, I think that would have contributed. And the other thing is, after all of this decisioning, taking difficult decisions and tracking all the companies and seeing what the performance of those companies is and deciding whether to buy or sell. uh, After doing all of that, if you're still not able to beat the index, then what is the point exactly of investing in that manner? I think that is what would have resonated with some investors, and they would have chosen index funds over this direct way of buying equities. And the other thing that you mentioned is about government schemes, right? I think uh, there is some amount of growing disenchantment with the way these schemes are structured. We are seeing complaints about difficulties with EPF rise. The returns have been quite flat for a number of years now, despite inflation going up so much. So people are finding flexibility, better returns, better charges, better transparency elsewhere. So I think that is why they're choosing to move away from all of these options towards mutual funds, which offers them all of this flexibility. Sneha.
Makes a lot of sense. Thanks for putting that into perspective for us. Let's move away from equities, talk about insurance now. Now, when I read your report, I notice that health coverage has improved marginally. There has been a drop in life coverage. The percentage of people who have neither of those two, nor health insurance nor life insurance, has nearly doubled. Could you help us understand why people are losing confidence when it comes to the insurance space, if that would even be the correct way to put it? Because we have seen some negativity around this space recently. It could be on the back of regulations, but help us understand why people are shying away from insurance, both on the health and the life part.
Sure. So this is definitely a troubling trend where people are choosing not to buy life insurance. So we are seeing a decline in people investing through life insurance. So endowment plans, cashback, ULIPs, all of that is seeing a decline. But there is also an overall decline in life insurance uptake. So 1 week after we put this report out, interestingly, IRDAI came out and did its own annual report and said that there is definitely a visible decline in life insurance uptake. It specifically pointed to life insurance, which kind of validated what we were saying. So my personal view on this is that some years back we started the adoption of the new regime, the new tax regime, and one of the selling points for that option was that it will streamline everything, right? So you don't need to buy you don't need to buy tax saving investments. You don't need to buy tax saving insurance products. And at that point, I remember Bank Bazaar saying that don't forget to buy your health insurance and life insurance, because that's still important. I mean, tax benefits are a secondary benefit you get from that, but the primary benefit is still protection, and you need protection even if you choose to go to the new regime. I believe, it's my personal view, that the new regime may have contributed a little bit to this trend, where people don't realize that the primary reason people need to buy life insurance is protection, and maybe they're choosing not to buy it because they believe that what's the point now, if there's no tax benefit to it, why should I buy that plan, why should I pay the premium? Maybe that's the reason why it may be happening, Snehi.
Okay, that's actually a little bit contrasting to what I have noticed when it comes to retirement. You have more people who are getting worried and getting cautious. They're planning towards their retirement. So on one hand, having a bleak outlook on life insurance, and on the other, being very cautious on retirement, are two things that are very contrasting. Interesting to just point that out, making an observation. But moving on then, I also want to talk to you about this entire retirement segment. Because with the growing popularity of FIRE or FIRE that we've seen, which is Financial Independence, Retire Early, this movement has picked up. It's gained a lot of popularity among the current working population. How do you see Indian investors adopting this approach, and what steps are being taken in that direction?
So it's very interesting, Snehi, because a lot of people from my generation, for example, millennials, are seeing that we may not be able to replicate the work lives that our parents had, for example, right, where they continued working into their 50s, 60s, sometimes even 70s. My generation is thinking maybe I can wrap it up by 50 and then pursue my personal interests, start a business or start a bakery or teach yoga or anything, right? That's how people around me are seeing this particular problem. And there is definitely a rising awareness of the whole FIRE movement, right? So much content has been done on it, so much awareness has been created on it. So that would have definitely contributed to the idea that you don't need to slog till your 60s. You have an option. If you really plan out your investments, your retirement savings, then you can have an exit much before your 60s. I think that's what's contributing to it. Apart from the fact that we are in a tight economic scenario where not a lot of high-paying jobs are available, and people are thinking, what next, right? So you have to think about what's coming in 10 years or 15 years, 20 years, where there could be all sorts of disruptions to your own career, and you need to have your options sorted out. You need your plan A, B, C. And people are realizing that investing through SIPs and mutual funds is a no-brainer. Now, that is how you can accumulate money slowly over time. And everybody now has a number that they can work towards, right? So people are working towards 300x or 400x, whatever number they might have in mind. So lean FIRE, fat FIRE, people have started figuring this out, and we see a gradual uptick in the number of people who are saying that they are in a much better situation compared to where they were earlier when it comes to retirement planning. In fact, in our survey, almost 66% of the respondents said that they are either ahead of their target or on target in terms of achieving their goals in whatever timeline they have decided, or whatever amount of money they need to save. Snehi.
Perfect. On that note, Mr. Hemant, we'll let you go. Thank you so much for joining us, breaking down your report so beautifully and explaining these various personal finance concepts to our viewers via your report. Thanks so much for joining us. It's a pleasure to speak to you. Have a good day. Okay, well, on that note, viewers, time to slip into a short break on this edition of The Money Show. We'll be right back, so you stay tuned.